GameStop wants to buy eBay. A struggling video game retailer wants to acquire one of the largest e-commerce platforms in America. The offer is worth roughly $56 billion, half cash, half GameStop stock. And the strangest part is this: GameStop itself is much smaller than the company it wants to buy. This is not a normal acquisition story. This is not just a retail turnaround story. This is not just Ryan Cohen trying to build the next Berkshire Hathaway. This is a perfect snapshot of the broken economy. A world where debt looks like strategy, stock dilution looks like innovation. Retail investors become the fuel. And a company that once became famous as a meme stock is now trying to use meme power to buy a real business. Welcome back to Broken Economy. Today, we are breaking down the GameStop eBay deal, not from the perspective of hype, not from the perspective of diamond hands, not from the perspective of Wall Street bankers, but from the perspective of the ordinary investor, the person holding GameStop stock, the person with money in a 401k, the person watching financial markets become more detached from the real economy every year. Because the question is not just whether GameStop can buy eBay. The real question is this: who takes the risk and who gets paid if the story works? GameStop officially proposed to acquire eBay for $125 per share. The total offer is roughly $55 to $56 billion. The structure is half cash and half GameStop stock. On paper, that sounds bold. In reality, it raises one giant question: where does the money come from? GameStop is not Apple. GameStop is not Microsoft. GameStop is not Berkshire Hathaway. It is a company with a much smaller market value than eBay. It has cash. It has a loyal retail investor base. It has a famous CEO. It has meme stock history. But buying eBay is not the same thing as posting on social media. A $56 billion acquisition requires real financing, real debt, real stock issuance, real risk, and possibly real dilution for shareholders. That is where this story becomes dangerous. Because when a smaller company tries to buy a much larger company, it usually needs leverage, debt, new stock, bridge financing, financial engineering, and maybe the cash flow of the target company itself. This is the oldest trick in aggressive deal-making. Buy the company. Use debt to fund the deal. Then use the acquired company's cash flow to help service the debt. In simple language, you buy the building. Then the building has to help pay for the loan you used to buy it. That may sound clever, but clever does not always mean safe. And debt does not become creativity just because the story is exciting. That is why Michael Burry's reaction matters. Burry once saw potential in GameStop. He understood the original value argument before the meme explosion. But after this eBay proposal, his tone changed. His warning was simple: never confuse debt for creativity. That sentence cuts through the entire deal. Because this is exactly what modern finance does. It takes a balance sheet problem and calls it strategy. It takes leverage and calls it vision. It takes dilution and calls it growth. It takes risk from one group of people and transfers upside to another. Now look at Ryan Cohen's position. Cohen is not just a CEO. He is the symbol of the GameStop movement. To many retail investors, he is the person who might transform GameStop into something much bigger than a dying mall retailer. Some investors see him as a disciplined operator. Some see him as a meme king. Some see him as the only person crazy enough to attempt something this large. But the incentive structure matters. GameStop announced a massive long-term performance award for Cohen. The package includes options that could become extremely valuable if GameStop reaches aggressive market value and operating goals. That does not automatically mean the eBay bid is bad. It does not automatically mean Cohen is acting in bad faith. But it does mean investors need to ask a serious question. Does a huge acquisition help build per share value, or does it mainly help create a larger market cap story? Because those are not the same thing. Market cap can rise because a company becomes truly more valuable. But market cap can also rise because a company issues more shares, takes on debt, buys another company, and creates a bigger headline For retail investors, the key question is not, can GameStop become bigger? The key question is, will each share become more valuable after dilution, debt, and execution risk? That is the part meme culture often ignores. Market cap is not the same as shareholder wealth. A bigger company is not automatically a better investment. A larger empire does not automatically mean better returns for the person holding the stock. If GameStop issues a large amount of stock to fund this deal, existing shareholders may own a smaller percentage of the combined company. That is dilution. Dilution is not always bad. If the acquired company creates enough value, dilution can be worth it. But if the deal is overpaid, over-leveraged, or badly integrated, dilution becomes a transfer. Existing shareholders give up ownership. The company gets bigger, the story gets louder, but the per-share economics may not improve. That is the retail investor trap. You are told to focus on the dream, but your actual ownership may shrink. Now, let's talk about eBay. eBay is not a dead company. It is not a perfect company either. It has issues. It has competition. It has growth challenges. It has execution problems. But it still has a real platform, real cash flow, real users, real infrastructure, real marketplace economics. So the core argument from Ryan Cohen seems to be this. eBay is undermanaged. GameStop can cut costs. GameStop can use its stores for fulfillment. GameStop can combine retail loyalty, e-commerce, and financial engineering, and the combined company could become much more valuable. That is the bull case. But the bear case is just as serious. GameStop is attempting to swallow a company much larger than itself. It would need major financing. It would need eBay shareholders to accept GameStop stock as part of the payment. It would need lenders to stay confident. It would need regulators and shareholders to accept the logic. It would need integration to work. It would need cost cuts to actually materialize. It would need the market to believe the story long enough for the deal to survive. That is a lot of need. And when a deal depends on too many perfect outcomes, ordinary investors should slow down, because the market loves a story, but debt demands cash flow. The market loves vision, but lenders demand interest. The market loves memes, but acquisitions demand execution. That is where meme finance crashes into reality. This is why the GameStop eBay proposal is bigger than one company. It shows what financial markets have become in 2026. A company does not need to prove a transformation first. It can announce a giant deal, trigger a media cycle, activate an investor army, force analysts to react, force eBay to respond, force Wall Street to debate it, and suddenly, the stock itself becomes part of the financing engine. Attention becomes capital. Hype becomes leverage. A headline becomes a balance sheet tool. This is the meme economy. And in the meme economy, the line between strategy and performance becomes extremely thin. The CEO is not just running a company, he is running a narrative. The stock is not just ownership, it is currency. Retail investors are not just shareholders, they are distribution. They spread the story, they defend the leader, they fight the critics, they absorb volatility, they hold through dilution, and in some cases, they become the liquidity that allows insiders, lenders, and institutions to play a much bigger game. That is the uncomfortable truth. The GameStop community may believe they are fighting Wall Street, but Wall Street may be learning how to use the community. This is not about mocking retail investors. Retail investors were right about many things. They were right that markets were unfair. They were right that hedge funds had too much power. They were right that financial media often serves institutions. They were right that ordinary people were treated as exit liquidity for decades. But being right about Wall Street does not make every meme stock CEO a savior. A broken system can create false heroes, and false heroes can still use the same system. That is the deeper danger. The original GameStop story was about retail investors challenging Wall Street. This new GameStop story may be about retail investors being asked to fund the next financial experiment. That is a very different movie. Now think about the timing. The real economy is under pressure. Consumers are stretched. Credit card balances are high. Rates are painful. Small businesses are struggling. Physical retail has been weakening for years. GameStop's core business is not suddenly becoming a growth machine. Stores have been closing. Gaming has moved digital. The mall economy is not coming back the way it used to be. And yet, in the middle of this real-world pressure, the company proposes a massive e-commerce acquisition. That contrast is the broken economy in one image. On the street, stores close. On CNBC, the CEO talks about buying eBay. In real life, workers worry about rent. In the market, people talk about turning GameStop into the next Berkshire Hathaway. At the cash register, the business is shrinking. In the stock market, the story expands. That is the great disconnection. The financial story grows larger as the physical reality gets weaker. This is why the deal has such high viral potential. It feels absurd. It feels impossible. It feels entertaining. It feels like a movie. And that is exactly why it works as a market event. In the modern economy, absurdity is not a weakness. Absurdity is attention, and attention is valuable. That is why a CEO can auction personal items on eBay while trying to buy eBay. It sounds ridiculous, but it keeps the story alive. It turns a financing question into a meme. It turns skepticism into engagement. It turns doubt into free marketing. And suddenly, everyone is talking about GameStop again. That may be the point. Even if the deal fails, the headline succeeds. The company becomes relevant again. The stock gets attention. The community reactivates. The market debates Cohen's genius or recklessness, and Ryan Cohen stays at the center of the story. That is why retail investors need to ask, is this acquisition primarily a business strategy, or is it a market strategy? Because those are different things. A business strategy creates durable cash flow. A market strategy creates attention, liquidity, and valuation pressure. The best companies can do both, but the most dangerous companies use the second to distract from weakness in the first. Now let's talk about the 401k investor. Most people think this story is only for GameStop holders. It is not. It matters for every investor because it shows how markets are changing. If meme power can help a smaller company attempt to buy a much larger company, then stock market structure is becoming more performative. Index funds, retirement accounts, passive flows, retail communities, social media, and executive incentives all interact in ways that did not exist decades ago. Your retirement money may own companies whose valuations are shaped by narratives more than fundamentals. Your index fund may hold businesses that rise because of liquidity, not productivity. Your 401k may be exposed to a market where attention can temporarily overpower cash flow. That does not mean markets are fake, but it does mean markets are more fragile than they look. Because when narratives break, valuations can collapse quickly. A story can create wealth on the way up, but it can also destroy wealth on the way down. And retail investors are often the last to accept that the story changed. This is the real lesson. Do not fall in love with a CEO. Do not confuse a community with a balance sheet. Do not confuse dilution with growth. Do not confuse debt with creativity. Do not confuse market cap with per share value. Do not confuse a headline with a business model. Because Wall Street has become very good at turning belief into financing. And once your belief becomes financing, you need to know who controls the terms. Now, could the GameStop eBay deal actually work? It is possible. A combined company could cut costs. eBay could benefit from more aggressive leadership. GameStop's retail following could create unusual traffic. A stronger e-commerce strategy could unlock value. There may be real inefficiencies at eBay. There may be real upside in the marketplace. But a possible upside does not erase the risk. The deal still faces financing risk, dilution risk, debt risk, integration risk, regulatory risk, execution risk. shareholder resistance, market volatility, and the risk that the entire proposal is more effective as a headline than as a plan. That is why the correct response is not blind hate, and it is not blind faith. The correct response is analysis. Ask what happens to existing shareholders. Ask how much debt is required. Ask how much stock must be issued. Ask what the combined company's cash flow looks like. Ask whether cost cuts are realistic. Ask whether eBay's shareholders would accept GameStop stock. Ask whether lenders believe the combined company can carry the debt. Ask whether Cohen's incentives align with per-share value or market cap expansion. Ask who benefits if the stock price rises on the story. Ask who pays if the deal fails. Those are the questions serious investors ask, not whether the meme is funny, not whether the CEO is charismatic, not whether the community believes, not whether the shorts are scared. The math matters. The structure matters. The incentives matter. This is why the GameStop eBay proposal is the perfect broken economy case study, because it contains everything wrong with modern markets: a struggling real-world business, a giant financial narrative, a charismatic CEO, a loyal retail army, an enormous compensation package, a massive target company, debt financing, stock issuance, potential dilution, media spectacle, and a market that rewards attention before it rewards execution. This is not just a deal. It is a mirror. It shows us an economy where growth is harder to create in the real world. So companies try to manufacture growth through financial structure. It shows us a market where attention can temporarily act like capital. It shows us a system where ordinary investors may believe they are part of a revolution, while the actual deal terms may expose them to the most risk. That is the retail investor trap. You get the story. You take the volatility. You absorb the dilution. You defend the leader. And if it works, insiders may capture enormous upside. If it fails, the losses get distributed across the crowd. That is the part nobody likes to say out loud. Now go to the comments and tell us what you think. Is Ryan Cohen building the next Berkshire Hathaway? Or is this a giant meme finance stunt? Would GameStop buying eBay be genius or reckless? Are retail investors about to win again? Or are they being turned into exit liquidity for the biggest financial performance of 2026? And most importantly, do you trust a company to buy a larger company when the money depends on debt, stock, and belief? This is Broken Economy. We break down the financial system behind the headlines. Subscribe for more clear analysis of markets, technology, and the real economy behind everyday life. Stay awake, because in the meme economy, the story can make you rich, but the structure can leave you holding the bag.